In this session, we will be primarily dealing with private real estate investments. How does real estate differ from traditional investments? What are the advantages and disadvantages of going ahead with the real estate investments? What are the various forms of real estate investments that are there? And probably how do you value each of those real estate investments, and how do you find out what is the return that you are getting on each of these investments? So this is what we typically cover in this session. So let's look at each of these things in detail. Whenever we look at real estate today, it is one of the very important asset class as a part of many investment portfolios. We see a lot of people saying, okay, I have invested in stocks, I have invested in bonds, but along with that, some portion of my money I have invested in real estate. So, buying a property, or we will talk about various other mechanisms of investing in the real estate market. But overall, the real estate market looks one of the most important asset classes today, and from an investment perspective, people perceive real estate as one of the strongest mechanisms, or one of the best tools that is available for them for various benefits. It is treated as a good diversification kind of an instrument. The reason being, real estate, the way it behaves, the way the prices in the real estate market behave, is considered to be completely different, or probably opposite to that of what the traditional investments behave. So there is a lot of difference in the characteristics of real estate as an investment compared to many other traditional investments, because of which real estate is perceived as a good diversification tool. But when we talk about private real estate, it's more like purchasing a property, right? So whenever we are doing something like that, it is not that liquid, it is not that traded heavily in the secondary market like a stock. So the valuation which we do for this kind of private real estate is completely different from what we do for a publicly traded security. So we have to be very careful about the valuation methods that we engage here. And the advantage which is typically seen is, whatever the factors that are being thought of as impacting the real estate performance or impacting the value of the properties, they are same across the countries, which means if I understand the valuation methodologies, if I understand the mechanisms of valuation, probably even a cross-border investment in real estate becomes quite more comfortable. But as you all know, even today, real estate is not that fully organized as your various other markets. So the data availability and all are still a big issue as of today. But with the availability of data becoming more and more easy, you can expect that the real estate market is going to become more and more efficient in the times to come. So in that case, it is worth learning the various valuation techniques to evaluate the worth of a property, on what dimensions I should look at evaluating the worth of a property, and what kind of properties are evaluated on what basis. All these things become more and more important. Now, just to understand the various forms of real estate investments, I look at the 4 dimensions. One is the public debt. So we can create it like a grid: a public versus a private, and debt versus equity. These are the 4 forms of investments I can look at in the real estate space. So there is a public debt where It is nothing but I am acting as a lender there, and that particular securities are publicly traded. Generally, the mortgage-backed securities will form under this public debt, because I am investing in a security which will invest in the real estate in the form of loans, which will lend to the real estate sector. So the mortgage backed securities, or we'll be talking about real estate, mortgage based real estate investment trusts. So all these things go as a part of the public debt kind of investments. Whereas when we talk about public equity, means my investment is in the form of an equity, and that equity is publicly traded. Probably if I buy the share of a real estate company, it's as if I am investing in real estate, and I have an equity stake in the ownership of that company, and the shares of my shares of that real estate company are traded publicly. So that's where I say such kind of investments are public equity investments in real estate. Similarly, when I am enrolling myself, or when I am subscribing to the shares of real estate investment trust, which are again nothing but another set of funds which invest in real estate with an intention of generating some kind of income out of them. So all these kind of investments typically are treated in the form of public and equity. But when I look at it from a private debt, I myself purchase a property, or probably I lend to someone. So like a bank is investing in a private debt market. It is investing, it is lending to the people who want to buy or sell properties. Who want to buy properties, it is lending to them. So in a way it is working, it is operating in the private debt market. Whereas in a private equity market, me who am investing to buy a house, a direct purchase is what is a private equity, or probably a partnership, or we are pooling together to buy our apartment. All those things are going as a part of private equity kind of investment. So if we see any kind of investment that goes into the real estate market, it should fall into one of the four categories, depending on whether my particular security is publicly traded or not, and what is the mode of financing there. Is it more of debt or equity? Based on these four characteristics, based on these 2x2 kind of a grid, or based on these two different characteristics in two dimensions, I can look at, okay, where exactly is my investment forming in, and based on that I will evaluate the characteristics of that particular investment. So every investment has even each of these four, the categories, their properties are different with respect to risk, with respect to returns. All these things I think we should appreciate. But apart from that, a few important aspects. This is a very common thing, not about just real estate. Debt has a priority claim over the equity in case of default. So if I have lent, or if I have invested in mortgage-backed securities, where the investment is in the form of debt, whether it is private or public, investment is in the form of debt. So in case the borrower defaults, probably the debt investors are the ones who are getting a priority in the claim. So that is one advantage, which means the equity investors, they are going to get only the residual of the property. Out of the total value of the property, if I remove the value of the debt, whatever is left, it could be more than the current market, it could be more than their investment, or it could be less than their investment. But that is what value the equity investors are going to get in this process. And when we talk about a debt versus equity investment, in the equity investment, probably people can look at a regular flow of income, and along with that a capital appreciation also. Whereas in case of debt investment, they cannot look at capital appreciation, they are only lenders. they have to get back what they have lent along with the regular interest. Any capital appreciation or a depreciation really does not add any value to a debt form of investment. So if the real estate prices are growing up dramatically, then probably equity investor will get a much bigger return compared to a debt investor. And at the same time, if the real estate is falling drastically also, the debt investor will not lose that much, whereas an equity investor can lose very heavily. So the risk as well as the expected returns, the regulations are different for each of these investments, for each of these forms. The legal and the market structures, everything are different for different firms. So we have to really evaluate where exactly our investments are lying. And as some of the facts are suggested, private investments are generally much larger than public, because one, the property is generally indivisible. I cannot break a house into 500 pieces and sell one piece to each person. So the indivisibility of the house is a very big concern, and at the same time illiquidity. I cannot sell them whenever I want. So the private investments, typically whatever one single investment we are making, the size of that investment is very large. But when we deal with public investment slightly later in the form of real estate investment trust, they give us a kind of ownership on a portion of a house based on the value of that house, and we are investing in the shares of a fund which is tracked based on the value of the property. So it's not the house, underlying house that is typically bought or sold, but in a way we are trying to invest in a fund which will in turn invest in multiple properties. So our share in one single property is pretty much limited. Just like a mutual fund, you should look at real estate investment trust. We'll deal with these concepts slightly later in the next session. But any private investments in the real estate, we see that the size should be very large because of indivisibility as well as illiquidity. And as I'm just pointing out, the public investments are more liquid because we are talking about the small divisible kind of portions itself which are sold in the secondary markets, that are tradable in the secondary markets. So they are more and more liquid, so they provide more and more diversification. And REIT is just like mutual funds. So the only difference is mutual fund typically is a pool which will invest in stocks and bonds, whereas REITs are a pool which will invest heavily in real estate. So probably for now we can look at such a kind of a comparison between real estate investment trusts and mutual funds. So just like mutual funds, REITs are also very professionally managed, so I don't need to really get into the evaluation of the property or develop some property management expertise, which otherwise in a private investment that is very much mandatory. And most of the real estate investments go with very heavy leverage. Generally they are invested based on borrowed funds, so the leverage increases in case of real estate investment, especially private real estate investments. There is a lot of borrowed funds that are typically used, which will overall increase the returns to the investor, which we'll see towards the last, as can be measured by using IRR or leveraged IRR kind of concepts. And whenever we are looking at from the perspective of equity investors, the kind of benefits they are going to get is the regular income in the form of rentals and capital appreciation of the property. And the biggest thing about the real estate investment is they are fixed locations. The location cannot change, and they are very difficult to value because each property is unique. See, when a company has issued a stock, all the shares of that particular stock are more or less the same. They are all equitable. Whereas when we talk about the property, each property is unique. Though all construction materials and the model, everything is the same, even there could be slight differences that are existing from property to property based on the kind of internals that have been done on it, based on the kind of furnishings that have been done to it, based on the kind of location it is present, based on the distance from the nearby shopping centers. All these things will change the value of the property. So most of the properties have to be valued in a unique manner itself. So that's where the valuation becomes very difficult when it comes to the real estate property. That is what, no two properties are unique, are identical, everything is different. And because of the indivisibility, each property may have to be purchased at a very high value, which means the diversification by buying 10 different properties becomes very difficult. One property in a low cost area, the other in a high cost area, that kind of a diversification by buying multiple properties becomes very difficult. And active day-to-day involvement is required, especially for the properties which I am giving for some hospitality purposes like hotels and all. The active day-to-day involvement in the operations of the property is very much required. Transaction costs are much higher, and unlike various financial assets like stocks and bonds, the real estate property actually undergoes depreciation, especially to the building. Because it's a physical asset, it's not a financial asset, it's a real asset. So it will undergo some amount of depreciation with the age, whereas the financial assets do not undergo depreciation. And as we have already discussed, most of the real estate property typically go with, most of the real estate investments typically go with the debt. So the availability of the debt capital and the prevailing interest rates really have a very huge influence on the demand for the real estate market. When heavy capital, when loans are available, there could be a lot of demand for real estate. Whereas when the loans are not available, the demand for real estate could even go down, which could increase the prices, or vice versa. Then this is highly illiquid. Selling off a property cannot happen immediately when I want. And because of these reasons, we say this is not efficient market, because underpricings and overpricings are very much possible because of one being illiquidity, two being the valuation mechanisms may be different for different properties, and because of unique characteristics for each of the property, we cannot say that this particular market is fully efficient like the stock market or bonds market, where proper evaluation mechanisms and valuation models can be used. Here also we will be using a valuation model, but the assumptions that are built into that model, they are unique for each property. So that's the reason we are saying the valuation becomes a very difficult approach when it comes to the real estate investments. The traditional real estate here means like proposition of the property. We are not discussing about real estate investment trusts here. We are not discussing about mortgage-backed securities here. A traditional real estate, which is more of a buying and selling of a house or commercial properties or something like that. Okay, now a few more interesting aspects about this real estate. We can classify the properties into generally residential and non-residential. And in the residential, single family homes, which are primarily from the perspective of of staying and of living there, they are all residential. And even the multi-family homes, Yeah, here if there is a commercial motive in terms of, yeah, I have built a multi-model, multi-family home, and I would be selling them to various individuals, then it becomes a part of the commercial, right? But in the non-residential, so some residential is again a part of commercial, and when it comes to non-residential, generally we talk about the commercial properties depending on the usage. So if it is an office specific, we call office based property. Hotels, hospitals are, so lot of properties can be classified in different forms based on the usage they are put to, and some of them require more and more day-to-day maintenance, like your hotels and all. The maintenance is very high, whereas with respect to the offices and all, I will lease them to some companies and they will take care of the maintenance part of it. So it depends on for what purpose is that particular property being put to use. And apart from the regular commercial, we even classify them as farmlands, because these are treated as a slightly different commercial property, because along with the capital appreciation for the land, I can produce a saleable commodity. It can be used for rice, wheat, groundnuts, any kind of crop can be grown, cotton, tobaccos, any kind of a crop can be grown which is a saleable commodity year over year. So that kind of an income generation is there, and along with that a capital appreciation exists for that kind of a property. And when it comes to a typical real estate investment, it generates regular income in the form of rents, but of course some regular expenses also exist. But any typical real estate investment, especially if it is a building, whether it is residential or commercial, it can generate some kind of investment for us, and there is a price appreciation. Depending on the location and various other factors, the price appreciation could be there for that particular real estate investment, and it is treated that it acts as a good hedge against inflation, for the simple reason, generally when the inflation is high in a country, parallelly I see that the real estate prices also go up, or even the commodity prices go up. So typically things like commodity and real estate are generally looked at as a hedge against inflation, because even if the prices go up, their value is going to go up in general circumstances. So which means they are treated as good hedge against inflation, especially when the cash flows of the property are positively correlated with the inflation, which in most of the cases will be. And we treat the real estate investment as a part of a good diversification strategy, because historically it is observed that the correlation of real estate prices with respect to the traditional stock and bond prices is much lesser. And in lot of countries we see tax benefits. Every country provides some kind of tax benefit for the investments in real estate. If I purchase a house, I get some kind of exemptions on the interest amount which I am paying, which I will not get if I am paying interest on other loans. But if I am paying an interest on housing loan, I get some benefit. Even on the principal payment, I may get some benefit. So especially when I am getting into the real estate purchases, to a large extent I see there are some tax benefits at various stages. So because of all these things, real estate investment look more lucrative compared to the other form of investments. Then coming on to a better classification of the commercial, as I am looking at the commercial properties, we generally classify as core versus non-core. Core is the ones, that set of property which will help the investor to create a low risk profile portfolio. So an investment in office properties, investment in industrial properties, retail and multi-family apartments, they are treated as less risky kind of investments, and they form a good diversification benefit for any typical investor, because office in general, there will be a demand for office properties. Yeah, more and more jobs are getting created, the more demand can be created for those kind of office properties. So the way you can give the office property on a lease or a rental basis, once you have invested, you can give it as a gross lease where you would be responsible for operating expenses, or you can give it as a net lease where the tenant will be responsible for the operating expenses. But overall, any office space, investing in an office space and then giving it as a rentals to various officers is definitely a value added proposition and a least risky proposition, because as long as the job market exists, the demand for these office properties also keeps on existing. And coming to the industrial spaces, like it could be right from the warehouses or manufacturing locations somewhere in the outskirts of the cities, or probably slightly away from the city centers generally. But depending on the industrial activity that is available in the country, if the country is having more and more of economic growth and GDP growth and industrial activity occurring, the demand for this industry type commercial property will be much more. Again, retail, more and more of retail, you find heavy influence, especially if the spending behavior of the customer is very high, which will create lots and lots of avenues for various retail markets to come up, which means investing in any kind of retail is definitely going to be a hot cake. And finally, if the population is growing in a particular city because of job growth or for various reasons, multi-family buildings, which are more like apartments, they have lots and lots of demand. So investing in any of these properties is typically treated as a low risk real estate portfolio, whereas investment in non-core, especially like hospitality related things like hotels, in a typical hotel industry, there cannot be long-term leases. Leases could be very, very shorter terms, which means when the lease is getting revised, there could be a very heavy increments and all to the loan value, to the rental values and all. Whereas the performance side, they are very much subjected to the business cycle. When the economy is doing well and when jobs are very heavy, when a lot of tourists are coming in, probably there is a demand, but in off season the demand might go down quite drastically. So this investment in these kind of properties generally is treated as a high risky kind of an investment. It cannot be a big diversification strategy. It requires more and more actively involved management in terms of day-to-day operation, which makes the non-core kind of real estate investment slightly different from the typical core investments. Now, whatever may be the type of investment we are looking at, now we have to look at how do I value all these properties. And when I use the word value, my usage is from multiple dimensions. And in the market also, people when we talk about the word value, they use different values. One is market value, which is more of a buy-sell price. So what a seller is willing to sell it and what the buyer is willing to buy at, that is what we call as the market value. Whereas when I say value in use, it is looked at from the perspective of the person who is using that property. His intention is not to sell it. Probably if I have bought one property to use it as a part of my business, how much rental it is generate, or probably how much of revenue it is generating. So I value that property. If the property was not there, what was the value of my business? Versus with the addition of that particular property, what is the value of my business? The difference between the two is what we call as value of use. So should I evaluate this property from the perspective of usage, or should I evaluate it from the perspective of selling it? Or sometimes we use the value word as assessed value, which is purely from a tax dimension. So from a property tax payment perspective, what is the way the tax authorities assess the value of this particular property? Or from a lender standpoint, if I am trying to borrow based on the property, mortgage backed loan, if loan against mortgage. So whenever I am trying to take a mortgage backed loan kind of stuff, or so if a lending agency has to evaluate the worth of my property, what is the value that they assign to it is what we call as mortgage lending value. And when it comes to the land, we even use a word called implied value. What it is, see, if at all I am planning some two different kinds of ventures on this land. A venture A, which is like an apartment, residential apartment, and a venture B, which is more like a shopping complex. So this is going to cost me, let's say, 5 million, and this is going to cost me 10 million. Or probably if I am going to sell it, let's say I am going to get 5 million out of it. If I am going to sell it, I am going to get 10 million out of it. So the value of the residential apartments is 5 million, whereas the value of the same place being used for shopping complex is 10 million. But assume that it is going to cost me 3 million to construct it, including my profits, whereas this is going to cost me, let's say, 8.5 million to construct along with my profit. So the difference which I am looking at is what is the implied value of the land. So the implied value of the land in this case is 2 million. So when I am looking at the best usage of this property, the best usage of this particular land, especially for land we use this mechanism. If I have to look at the best usage of this property, I should look out for the one that gives me the highest value for the implied value of the land, but not the highest overall value after something has been erected on it. So this is one more thing that needs to be comfortable in terms of assessing the value of real estate property. Now, in this session, we would be dealing with the three major approaches to value a real estate property. We will look at a cost approach. Cost approach is nothing but whatever is the value of the land and whatever is the cost. In case you want to build a new building which is exactly similar to the existing one, what is the replacement cost for it? Or probably if I want to sell off that particular building, or if I want to create an exact replica of the same building, how much is the cost for it? So that is what we are calling as the replacement cost. And out of that replacement cost, probably depending on the age of the building and age of estimation of obsolescence, sometimes because of design issues, location issues, there might be some kind of additional advantages or disadvantages that are associated. So when I say value of the land, it's a hardcore stuff. Cost of the new building, it could even include the construction costs for a similar building, for a similar kind of size and shape. What is the cost that I can incur for the new building of exactly the same stature? So which is nothing but the cost of materials and all for this kind of a building. And from there we are thinking of okay, the existing building, how old is it? So I will remove some kind of depreciation for it. And what are the costs of obsolescence? It could be because of locational disadvantage, or it could be because of design or facilities disadvantage or various other things that are associated with this particular building. So based on that we are finding the value, but of course here the problem is finding out the value of each of these things is not going to be that easy. So that's where we use this kind of a valuation mechanism generally for the unusual properties for which the comparable market prices are not available. Then we look at the other mechanism called sales comparison approach. We try to find out the various properties which are sold very recently and their features. So I look at okay, the property 1, 2, 3, they are sold very recently for different prices. So based on this, try to map their prices with their features in terms of how old is that property, what kind of location, is it a prime location or a secondary location, what is the condition of that property, good, bad kind of stuff. All these things you can very well figure in, and based on that try to come out with one average price per SFT if at all these properties are having similar features to the property which we want to sell now or which we want to value now. So obviously not everything can be same. So I am taking some comparable properties, and if at all the features of this property are exactly same as this property, what could have been the updated price. So basically I'll take the existing transaction, update the transaction under the assumption that each of these properties have the same characteristics as the property which I want to value, and arrive at average price per SFT which I would be using back into my current property to arrive at the price. We'll take a numerical to understand that. So we are trying to compare the prices of various properties along with their characteristics, and based on them we are trying to arrive at a price. And so that is what we call as a sales comparison approach. And the third one is called as income approach. This is purely looked at from the perspective of if I am able to give this property on a rent, how much income is it going to generate, how much expenses are incurred on it. So overall, what is the net operating income I am going to get in each of the years for the next few years. Find out the present value of all those future cash flows and find out the value. This is what is an income based approach. Here one thing we have to be understanding is the net operating income is what is taken as a proxy for cash flows in terms of evaluating in terms of evaluating the value of the property. So we'll look at each of these three approaches in detail. We'll start with the income based approach and then move towards the cost approach and the sales comparison approaches. Now looking at the income approach, as I just said, the net operating income is what is an input in this process. So which is nothing but whatever the gross income I can get. So it could be because of rentals and probably other income. If I am collecting some other income if I am getting some other income because of having this property, the summation of these two is called as a potential gross income. This potential gross income is under the assumption that my property will be fully occupied for the entire period. So if at all the property is having a 100% occupancy rate and all, I am going to get this potential gross income. So if at all there is an expectancy from the previous data that the occupancy rate is only 95%, means 5% of the time the property is unused. So based on that, whatever is the loss that I am going to incur, that 5% of this total rental value, because of the vacancies or because of non-collectability of the rent. So all those things are getting subtracted minus the operating expenses. Here when I look at the operating expenses, I'm purely looking at things like insurance or any maintenance, repairs, which will generally happen on a regular basis. So these are what we are calling as operating expenses, right? And probably in the other income, let's say I am collecting, apart from the rent, I am collecting a maintenance expense, a maintenance fee every year or every month. Even that could go as a part of the rentals, and the maintenance expenses which I am incurring can go as a part of the operating expense. Even the property taxes that I am paying, all these go as a part of the operating expenses. But typically the interest which I am paying towards the loan, or even the income tax which I have to pay, these things don't come under the perspective of operating expenses. So when we compute the net operating income, from this we subtract all these things. So the debt servicing cost, which is the interest, does not get included as a part of the computation of the net operating income. So for each of the future years, we compute the net operating income, or we estimate the net operating income based on the various assumptions we are going with. And the next thing, as a part of this valuation process, apart from computing the net operating income, we also compute the capitalization rate. See, we expect that the net operating income is going to grow at some percentage every year. So the net operating income, let's say if it is expected to grow at 5% every year, rentals going up, something else increasing, overall let's say the net operating income is expected to grow at 5% every year. That is what we call as the growth rate. The growth rate in the net operating income. And the discount rate typically is the rate of return which the investor is typically expecting. The rate of return which the investor typically expects, let's say I am investing in a real estate, so my expected rate of return is, let's say, around 12%. So the difference between these two is what is generally taken as the capitalization rate. What is the typical return that the investor is expecting versus what is the return the NOI is typically, what is the increase the NOI is generally generating year over year, what is the growth rate in the NOI. So the difference between the two is what is giving me my capitalization rate. So that is the way I define it is nothing but it is the return that is expected by the investor net of the growth rate in the net operating income. So that is what we call as the capitalization rate. Generally what people do is they derive the capitalization rate from the comparable transactions. How do I get for a comparable transaction? Just look at their NOI divided by their sale price. The next period NOI, their expected NOI divided by the sale price is what is going to give me the capitalization rate for each of those comparable properties. And generally what is suggested is, if I want to value a particular property, for the comparable properties you compute their capitalization rates, take the average of all those capitalization rates and use that for the current property. So just as a quick example, if I want to take, so there are three properties which I am using as comparable properties. Let's say a property which was generating an NOI of 100,000 recently was sold for 1 million. So the capitalization rate in this case was 10%. Another property which was worth 200,000, which was generating 200,000 NOI, was sold, let's say, for 2.1 million. So NOI is slightly lesser, so let me assume that it is around 9.5%. Now if I want to use these as my comparable properties to value my current property, then what I'll do is, because these two are the comparable properties, I'll take the average of their capitalization rate. So 9.75% becomes the capitalization rate for my company, for my property. So what I'll do is, I'll find out the net operating income for this property and divide it by the capitalization rate to arrive at the value of the current property. So that is one of the ways we get into the estimation of the value using this income based approach. So in this case, let's quickly look at some small numericals so that we can work out better on it. I'm talking about a property whose size is 50,000 SFT. Alright, so the size of the property is 50,000 SFT. The gross rental income is $10 per SFT. So $10 per SFT. So probably the gross income, if I want the gross income, it is nothing but 50,000 into 10, so 500,000 is what I can expect. Other income is 3% of the gross rental income. So I'll take other income as 3% of the gross rental income. So this is what we call as potential gross income. This is what we call as potential gross income. When assuming that the occupancy rate is 100% and assuming that all collections can be made, my potential gross income is to the extent of 515,000. And I'm saying occupancy rate is 96%. So vacancy rate, I can take the vacancy rate as 4%. So vacancy specific costs. Vacancy costs are nothing but the 4% of my gross potential revenue. 4% of gross potential revenue. So vacancy costs are expected to be 20,000. Then property taxes are expected to be some 28,000. Then we have insurance as some 13,000. Utilities and maintenance is expected to be some 60,000. So these are the costs per year. Interest expense is 40,000. As I said, interest need not be counted as a part of the net operating income, and even the income tax will not be used for net operating income. So while computing operating expenses, I will only look at the property taxes, insurance and utilities. So these are what are getting added to my operating expenses. So when I want to find out the net operating income, I am looking at the potential gross revenue, rental income minus the vacancy costs minus the other operating expenses which I am having. So the net operating income in this case I am treating as 393,400. That is what that is how we compute the net operating income in this case, right? Potential gross income minus the vacancy costs or collection costs minus the operating expenses, which are like regular expenses which are associated with that particular property. Those are what we call as operating expenses. They are working out to that number. And Now when I am using, let's say, the valuations, the income based approach to value the property, to find out what is the worth of the property, we are using a direct capitalization method, which is a straightforward, whatever is the NOI which I have got divided by the capitalization rate. So if I take this, use the NOI in the previous example and use a capitalization rate of 7.5. As I said, capitalization should be the expected rate of return minus the growth in the NOI per year. So if I am taking that as 7.5%, the value of the property using this approach is nothing but NOI divided by the capitalization rate. So it says this property should be worth 5.24 million. If I am expecting the NOI to grow at the rate of 5% every year, if I am expecting the NOI to grow at some percentage, okay, probably if my expected rate of return is 12%, in this case I am expecting the NOI to grow at 4.5%, making the net capitalization rate as 7.5%. So every year forever. Now how is that getting worked out? If you remember, if at all, let's say the next year NOI is 393,400. Now assume that there is a constant growth of 5% every year for infinite period, and assume that the cost of capital is 12.5%. Cost of capital is 12.5%. Now this is like a constant growth of dividend kind of a model. The present value is nothing but the next year value D1 by KE minus G. So the D1 in this case is the net operating income for the next period. K minus G, 12.5% minus 5%. So that is what we are calling as the capitalization rate here. So capitalization rate is just coming out from the perspective of the cost of capital, which is the required rate of return minus the growth rate in the NOI, because NOI is being used as a proxy for the cash flow in this particular approach. So in a direct capitalization, the assumption is the NOI is going to grow at that rate of G for an infinite period, and the cost of capital is also going to be the constant across the entire period. So under that kind of an assumption, we are finding out that the value of the property is nothing but the NOI of the next period D1, which is NOI 1, divided by the capitalization rate. Now, so if the capitalization rate decreases, the value of the property will increase, and vice versa. That's one way, directly looking at the value using the direct capitalization. Now that once we have computed NOI as well as the capitalization rate, I can directly use that value to compute, use those two values to compute the value of the property. And in this I also have, without taking the capitalization rate of the competitors, I go with a gross income multiplier approach. Right? I go with a gross income multiplier approach where I take the gross income which this property is generating, multiply it with the gross income multiplier. Here I am not going with NOI and all. I directly take the gross income and multiply it with the gross income multiplier. The simple way I arrive at that gross income multiplier is I take the sales price to gross income ratio for all the properties. So let's say I have one property which was sold for 5 million, which has a gross income. Here I can take NOI also as a part of the gross income. Or there is one more property which was sold for 10 million, which has generated 900,000 as the gross income. So like this, if I have so many such comparable properties, what I can do is I can find out their multiplier. I can take the multiplier of gross income sale price to gross income for all the comparables. If possible, take the average of all of them and say yes, for this property this is going to be the 11.8 is going to be the gross income multiplier. So I take the gross income for my current property, multiply it by 11.8 to arrive at the value. But all these, at least whether I am talking about a direct capitalization method or a gross income multiplier method, they are, in this method I don't compute the capitalization rate at all, right? I don't need to compute the capitalization rate at all in this method. I am directly arriving at a multiplier value and using that multiplier to find out the value of my current property. So it is inappropriate when the building to land ratios are different among comparable properties, because probably if the building portion is much more and land is much lesser, like an apartment built in a small area, the gross income multiplier approach will be much different, because land is something that doesn't get depreciated, whereas a building can get depreciated. So these kind of differences could create difference in the value when I am using the gross income multiplier approach. And these two approaches, they are not that effective for valuing if that property is occupied by the owner. Only if it is a rental, it can help me in terms of identifying what is the net operating income, and it can help me in valuing that property. But if it is more and more of owner occupied kind of a property, it does not help me in arriving at a proper value. Okay, one more example under this same context. A shopping complex is currently undergoing a renovation. Okay, expected NOI because of this renovation, I am expecting 1 million each in the next 2 years. If the renovation was not there, NOI was expected at 1.6 million per year for the next 2 years. Fair enough. After the renovation, it is expected that NOI grows constantly at 5% per year. So here, from here onwards, the NOI is going constantly at 5 million per year. What is the value of the shopping complex at the beginning of the renovation if the investor expects 10% ROI? Probably you can directly use. So from here, if you want, you can use the capitalization rate, because there is a constant growth rate that is going to come up, right? So 1.6 million, probably as of here, this is going to be 1.6, and from there going to be a constant growth at 5%. So as of here, I can find out the value as NOI, because wherever there is a constant NOI growth, the next period NOI divided by the required rate of return divided by the capitalization rate. So in this case, the capitalization rate is the required rate of return minus the growth of NOI. So the capitalization rate is 5%. So corresponding to the second and the previous periods, I can very well say that the value of this particular building is going to be somewhere around 1.6 divided by NOI by 5% capitalization rate. So 1.6 by 5% is what is going to be the value is what is going to be the value at the end of is what is going to be the value after 1 year. So what is the value? 1.6 million divided by 5%. So almost 32 million is going to be the value of this property at the end of 1 year, right? At the so corresponding to the 1.6 million that is going to be there in each of the years, that is what is going to be the value of the property or we can also look at from this period onwards, because here the growth is not constant, so probably I can look at this as from this period onwards there could be a growth of 5% per year drastically. So what we can also look at is there is a loss of 0.6 million because of this as on this date. So I can even find out what is the present value of that particular loss and reduce it from the value. So corresponding to this 0.6 million for 1 year at the rate of return of 10%. So 0.6 million divided by 1 plus R, which is 10%, is the value of the loss, because I was expecting 1.6 million but I am getting only 1 million because of the renovation. So the present value of the cost of renovation is going to be around 0.45, which means the cost of the property post the renovation is going to be only 31.45 million as of this date. 31.45 million as of this date, and in this year I am expecting 1 more million to be generated, so 32.45 million is the value after 1 year. So I can find out the present value as of the current year. So as of next year, along with the 1 million revenue which I am going to get, this is going to be 32.45 million, and I can discount this to the present value by dividing it by 1.1, saying the current worth of the property is 29.5 million. I can say that the current worth of this property is 29.5 million. So like this we can very well use the capitalization rate example as well as the required rate of return to arrive at the values of the properties at different points in time. Then apart from the capitalization rate kind of an approach, we can also look at a discounted cash flow approach, which is purely like, now instead of directly dividing it by a capitalization rate, in case of discounted cash flow method, you project all the future cash flows that you are going to get out of this property over the entire holding period, and at the end of the holding period, in case you are going to sell off this property, what are going to be the various cash flows that you are going to get at the end of each of these periods. They are to be projected, and apart from that, once we project, even the expenses that are going to be incurred, they will be taken care of and they are discounted to the present value. But the only thing that is a challenge here is what should be the discount rate that I need to use, and what should be the terminal years cash flows at the end of 5 years when I want to sell off this building, at what price I may have to sell. All these things will become a difficulty. So this is same as any other valuation mechanism, the dividend based valuation or free cash flow based valuation which we use in case of equity. The similar kind of a mechanism is used for real estate. You project what all revenues and expenses you are going to incur in future. Based on them, compute your cash flows for each of the periods and discount them to the present value. That is what is going to give you the value of the property using this discounted cash flow method. Now, if I am comparing it with the capitalization method, in the capitalization method, what did we say? NOI is growing at the same rate. So NOI should be the same, the growth rate in the NOI should be constant, and cost of capital also should be constant, which means the capitalization rate is constant using the capitalization method as well as this method. So if all these are going to be the same, then the discounted cash flow method is same as your direct capitalization method. Any differences here could give a valuation difference between the two methods. So all it is saying now is take the NOI in the previous example as the NOI for the next 5 years. Okay. So this is what was the NOI I have got. So take this as the NOI for the next 5 years, and after which NOI is going to increase at 3% for the next 3 years. Okay. So for the next 5 years I will take this as the NOI. And after that it is going to grow at 3% for the next 3 years, right? So it is growing at the rate of 3% for the next 3 years, and finally and after that grow at 5% forever. So this, after this, it is going to grow at the rate of 5% forever. Now I can find out the value. If the investor's required rate of return is 12%, compute the value of the property today. So how can I find out the value? As of today, as of this date, I can find out the value because there is a constant growth rate from here onwards at the rate of 5%. So I can use the capitalization rate method. NOI1 divided by the capitalization rate. Here the required rate of return is 12%. And 5% is the constant growth rate, so I will take the capitalization rate as 7, which will give me the value of 6.44 or 45 million at the end of 8 years. And now I can discount all these things to the present value. So I can find out the NPV now. So probably I'll take exactly these same values for these many years. And only for the last year I'll sum up these two things and find out. So out of this I can find out the NPV, which would be the value of the property. So I'll find out the NPV at the rate of 12%, and assuming that these are my future cash flows. Here I am using NOI as the proxy to the future cash flows. So in this case, this is getting worked out as the value of this property is getting worked out as 4.59 million. So if at all, now here you see, when I am using the direct capitalization approach, where I am assuming that the NOI is going to grow at a constant, where the direct capitalization rate is 7.5% forever, I have got that value as the property. Whereas here the capitalization rate is different because NOI and the growth rate are different. NOI is growing at a different rate for each of the years. Though the first year NOI is the same, the growth rate in the NOI in each of the years is different. And at the same time, the cost, though the cost of capital may be the same, the NOI growth rate is different in each of these cases, which has given rise to a different value using the direct capitalization method and a slightly different value using the discounted cash flow kind of a method. So that is how we use the discounted cash flow to compute the value of the property using the NOI. So one more thing you see here. A building was leased a few years ago for a fixed amount of $50,000 per year. The rent revision is going to occur 3 years from now, which means in the next 3 years, it is the 50,000 that is going to be paid by the lessee. And the expected rental value 3 years from now is going to be 75,000. Okay, so at the end of 3 years, the expected rent is going to be 75,000 for the similar property. 75,000 per year for similar property. Capitalization rate for similar rented properties is 7%. So from here onwards, at least from here, I will take the capitalization rate to be 7%. Assuming a discount rate of 5% for the rents, compute the value of the building today. So it's nothing but the present value, these three being discounted at the rate of 5%, Whereas whatever the rentals that I am going to get 75,000 per year from the fourth year onwards, I can discount them by 7%. So this is also a kind of a discounted cash flow kind of an approach itself, wherein I am saying, okay, the next year my rentals are going to be 50,000, the next year also are going to be 50, and the next year also they are going to be 50, and after that they are going to be 75. The rentals are going to be 75,000, and I am having a capitalization rate of 7%. So all 75,000s that I am going to get from later onwards, they can be discounted at the rate of 7% to give this as the present value. And so adding up all these rentals, so this is the first year rental, second year, third plus the fourth onwards till infinite. This is what it is. So I can find out the present value of all these rentals at the rate of 5% discounting, because the rentals are being discounted at 5%. It says that the value of the property is going to be around 1.06 million. If at all I want to value the property today, it is to be valued at the rate of 1.06 million using the discounted cash flow approach. In this itself, we talk about what is called as a layered approach. What do we do in case of layered approaches? Okay, value of the property based on current rent. Based on current rent, I will find out the value of the property, which means at 5% itself I can discount these rents. So the same 50,000, I'll discount it at the rate of 5%. So the value of the property as of the current rents is 1 million, and there is going to be a rental increase 3 years later. So value of increment in rent, it is going to be 25,000 increment, because from 50,000 it is going to increase by 25,000 to 75,000. So the value of the increment 25,000, I have a capitalization rate of 7%. So I discount that by 7%. So this is the value of the increment at the end of 3 years. So this is the value of the increment at the end of 3 years. So I can find out the present value of the increment, which is again, you discount this by 3 more years. The present value of the increment at the rate of 5% for 3 years. So this is going to be the present value of the increment. This is going to be the present value of the increment. So from here, if I am finding out the value of the property, it is going to be this plus this, which is 1.3 million. So if I am using this mechanism to value the property, it is going to be valued at 1.3 million, whereas when I am using a direct discounting of the future expected rentals, it is going to be valued at 1.06 million. So these are different kinds of dimensions I can look at for valuing this kind of property. And when I am computing the operating expenses for calculating NOI, one more thing that we need to be comfortable with is operating expenses. It's better that we break them off into fixed as well as variable like this. If the operating expenses are $5 per SFT for a 50,000 for a 10,000 SFT building, so typically the operating expenses per month are 50,000, out of which 40% is fixed, so 20,000 is fixed, 30% is variable. So 30,000 is the variable, right? So 30,000 is variable, means per SFT $3 is the variable expense, right? Apart from 20,000 which is fixed, the expense is $3 per SFT which is variable. Compute the operating expenses of the building if only 80% is occupied. 80% is occupied means only 8,000 SFT is being occupied. 3%, $3 per SFT. So 24,000 is the variable expense, 20,000 is the fixed expense. So work it out to 44,000 as the operating expenses, not 50,000. So that is one more thing that needs to be worked out. So basically, if at all I have to see what is the operating expenses per SFT, I take 44,000 divided by 8,000 SFT only, which will work out like $5.5 per SFT. It's not $5, it's $5.5 per SFT in case the building is not fully occupied. Only 80% occupancy exists for the building. Like this, we can solve some of the numericals that are associated with the valuation using either the direct capitalization method or the discounted cash flow kind of a method. Alright. So we'll move forward to the other methods of valuation now using the cost based approach as well as the sales comparison kind of an approach. Now looking at the cost based approach, where we are talking about first estimating the value of the land and find out the replacement cost of the building. What is the replacement cost? If at all I am looking at the current day's construction costs, today's construction costs, and including the profit, that is what I am calling as the current replacement cost for the building. So estimate the replacement cost for the building, and along with that, if at all a new building has to be built, that is the cost. So now make the deductions whichever are specific to the current building. Some defects that are associated with the current building, especially from the scenario of physical depreciation or physical deterioration, which is based on the current age to the estimated life. Let's say the building is 5 years old, but we are estimating the building to have a life of 20 years. So because it is already a 5-year-old building, there is some normal wear and tear that has occurred for it. So those kind of things you can remove the value, you can reduce the value for those kind of scenarios. And similarly, there could be something associated with the functional obsolescence, some kind of defect either in terms of features or in terms of the structural designs, right, or in terms of the floor plans or anything which is outdated. Because of that, there may be a compromise on the rental values, there may be a loss in the rental value because of the design being outdated. So you have to make appropriate deduction for functional obsolescence. I can look at locational disadvantage or locational obsolescence, wherein the location now is a kind of a remote location. It's nowhere an accessible kind of a location, or it's probably it is now surrounded by some non-habitable kind of entities, some kind of sewage nearby or some kind of disturbances nearby, so which can make that particular location as a disadvantageous location or undesirable location to the buyers. So the value which is a loss corresponding to that have to be deducted accordingly. And any other economic obsolescence that can come out, basically when we are talking about the current economic conditions wise, that kind of a building may not be feasible for construction. So when any other kind of disadvantages that are associated with the current building, they all have to be deducted to compute the value of the property using the cost based approach. So for that, it's always necessary that some kind of a construction activity is going on in that location. If at all the construction activity is halted, probably this kind of cost based approach is of not much of a use, because there is a remote the data which you are using is not up to date. So that aspect also need to be adequately considered when we are using this kind of approach. So just to work out on a simple numerical, I am thinking of finding out the value of this 50,000 SFT building, which is 10 years old, but it is expected to have another 20 years of life. So which means the 30 years is the expected useful life for the building. Out of that, 10 years has been consumed. So 1/3 is the already used kind of building. So the physical deterioration that we are thinking of, it should be deteriorated by the extent of 1/3. Okay, then the builder is so his the replacement cost is planned at 200 per SFT. So from here I can find out the total replacement cost. Okay, let me see now. I'll take the replacement cost, which will include the cost of constructing a new building, 200 per SFT. So we have 50,000 SFT into 200 per SFT, that is the cost of constructing a new building, along with the profit to the builder. So I am expecting a profit of 1.2 million. So the total replacement cost is going to be, the total replacement cost is going to be 11.2 million, and the market value of the land, if there are no deteriorations and all, the market value of the land is 5 million. So the total value of the property, in case there are no deteriorations or anything, it should have been to the extent of 16.2 million, right? Now what all we are saying, because of the poor design, rents are lower by 25,000 every year. So I can deduct right here. I have to assume some capitalization rate. So let me assume the capitalization rate is 6% for this numerical. I'll take, let the capitalization rate is 6%, otherwise I may have to compute it from the similar properties. So for every year the rents are lower by 25,000. So for this year I can very well reduce the rent with respect to that 25,000 every year at the rate of 6. So probably functional that is this is what poor design. So it's a functional obsolescence. Functional obsolescence cost is how much? 25,000 per year, growing at the rate of whatever is the growth rate, wherein I am looking at the capitalization rate to be something equal to this. So 416,000 is going towards the functional obsolescence, which is a bad design. Modernization required at a cost of 200,000. Okay, So the modernization cost is what I can compute, which is purely a kind of physical deterioration which is curable. So that is what curable physical deterioration, which is okay. Here, when we are talking about curable physical deterioration, I can cure it here itself. So the replacement cost, I will cure it and then sell it. So generally the curable physical deterioration, I will consider it as a part of this expense here. So the value of the property when I am considering here, I will subtract the curable physical deterioration and then take up, because this part will go as a part of the depreciation value. I will apply the depreciation on the replacement cost minus the curable physical deterioration, whichever is like a modernization or existing repair. I am doing an existing repair to bridge that particular repair. So and when I am looking at the depreciation part, it is applicable not on the land, it is applicable only on this part. So even that part I have to be slightly careful of. So here I will call it as the updated replacement cost, which is what is going to be the summation of these two, which is 11, and the market value of the land. So here what I'll do is I'll apply physical depreciation. So physical depreciation is applied on the top of this. So whether I do it here or there doesn't matter. So the value of the property is this plus this, but the only thing I have to be careful of is whenever I am doing age depreciation, which is a physical depreciation, which is non-curable kind of stuff, I know that the depreciation is 1/3 because the building is 10 years old, whereas the total expected life is 30 years. So the depreciation that is coming 1/3, I'll apply it on this 11 million, taking it to 3.67 million. That is the because of the obsolescence and location disadvantage. There is a location disadvantage which is losing 80,000 of rent per year. So again this also I can find out at the rate of 6% what is the loss. So almost 1.3 million is ending up as a loss here. So based on all these things, I can find out that the value of the property is going to be, okay, out of this entire 16 million, I'm going to subtract the functional obsolescence, the age based depreciation and a location disadvantage on it, and say that this particular property is worth 10.5 million as of today. This property is worth 10.5 million as of today using the cost based approach for doing the valuation of the property. So this is what goes as a part of cost based approach to valuing a real estate property. But of course this is based on so many assumptions that we are making. Some of the assumptions go into as simple as how much is the rental decrease because of poor design, how much is the rental decrease because of a location disadvantage. All these kind of things are going as estimates, and based on all these corrections we are trying to arrive at the value of the property. Generally this kind of a mechanism is done when very few comparable properties are available, because we are looking at each property as a specific thing in this case. Then the next approach for doing your valuations is the sales comparison approach, wherein we try to pick up a set of properties which are comparable on various grounds, So it and identify at what price they have been sold at in the recent transactions and their characteristics. So I'll capture their prices of each of the properties along with size, age, location, the condition of the property and various other factors, and try to do some kind of a regression relationship and try to arrive at, okay, if this property is in a prime location, add something more to it. If it is in a non-prime location, subtract something from it. All such kind of adjustments will be made with respect to the subjective the property which I am getting into the valuation. So for all those properties, let's say I have taken A, B, C as the base properties with which I will compare D, which is I want to find out the value of D. But to find out the value of D, I am taking A, B, C properties as the base. Now in this aspect, what we will do is, there may be differences that are existing between D and A, D and B and D and C. So what we will simply do is adjust A so that all the properties are similar to that of D. So the price could be either more or less if A is having similar properties as D. Find that out. Same thing, do it with B. If all the properties of B are same as that of D, at what price would it have been sold at? More or less? Capture that. And do the same thing with respect to C. So after that, find out what is their average price per SFT. Apply that average price per SFT to this D using the area of D and then finding out the value of that property. So this is a very good approach, especially when the real estate market is very active. So let's look at one example which can give some kind of insight for us into this. So I am taking three different properties A, B, C to evaluate D in this case. I want to find out the value of D using A, B, C as the base. Alright. So I am looking at a 30,000 SFT. So I'll capture all the comparable properties here. Right, size. In case of A, I'll take A, B, C and D, which is what we are looking at. So 30,000 SFT is for A, 28,000 is for B, 38,000 SFT is for C, and the D, which I am more interested in from my evaluation standpoint, it is having 25,000 SFT space. Okay, 25,000 SFT. So these are the sizes of the building. Then we are looking at a few more things associated. Right, I will try to find out the sales price for each one of them. Okay, the selling price. The selling price for A is 1 million, and in case of B it is 1.9 million, and in case of C it is only 0.5 million, 500,000, and D we are typically to find out what should be the selling price. When I look at the age, okay, here this is where I will look at each one. The age for this building is 10 years, whereas this is 8 and this is 6, whereas our current property is only 5 years old. Now all the properties that we are taking as a base, they are older compared to our current building. So we will do an adjustment, because what we said in a sales comparison approach, if all the properties which we are taking as comparables have the same characteristics as the property which we are valuing, what would be the appropriate price for them? So from that standpoint, we are finding out that some of the properties, or in this case all the properties, are older than our property, so there should be some kind of an adjustment So age adjustment, if I say this particular property is 5 years more older than our current property, and property depreciates at 2% per annum. Property depreciates at 2% per annum, and because this property is 5 years more older, I will adjust it on the upward side 2% per annum. So the age adjustment, what I will do is, whatever is its selling price, I will multiply it at 2% for 5 years. So there is an adjustment of 100,000 with respect to age for this. Similarly, there is an adjustment 2% per year for 3 years, because this is 3 years more older than our current property. And the same way for this property, we are adjusting it by 2% for 1 year. So after age adjustment, so the value after age adjustment, we'll do all kinds of adjustments like this. So the worth of this property, if it had been only 5 years old, this property would have worth 1.1 million. This property would have been worth 2.01 million and 510,000. That is one aspect. Then what else are the issues that are there? If the property is in a good condition, so based on the condition, so we have to look at, we are making an adjustment of plus 5% for good condition and minus 5% for the poor condition, and no change for the average condition. So I am looking at what is the conditions of the building. So A is in good condition. So A is in good condition, B is in average, and C is in poor condition, whereas D, which is our property, is in average condition. So because our property is in average, now I want to do an adjustment for condition now, right? I want to do an adjustment for condition. Now that if this property has been in a poor, in an average, because the subject RD is in an average condition. So if our particular property had been in an average condition, what could have been the excess? So I can decrease this value by 5%, right? If it had been in the average condition, I can decrease it by the extent of 5% of the total value, right? So the adjustment here, out of this selling price, I will decrease it by 5% because this is in a good condition. I will decrease it by 50,000. This I will not make any change because it's in the same. Whereas because it is in the poor condition, if it had been average condition, it could have got sold for 5% more. So I am adding up another 5%, 25,000. So after adjustment for the condition, after condition adjustment, the price is going to be something like 1.05 million here, 2.01 million here, and 5.35 million here. That is after the adjustment for condition. Then make an adjustment of 7% if the location is secondary and none for primary. Okay, so now I am looking at as a condition adjustment. So the location wise, A is in a secondary, B is in prime, C is in secondary, and D is also in a prime. So if it had been prime, I will not do any adjustment. So I'll do a location adjustment. If this particular thing had been in a prime location, the price would have been increased by 7% more. So if this is in the prime, I will increase it by 7 more percent. And because this is already in prime, I will not disturb it. Because this is in secondary, I will increase it by 7 more percent. So because of that, after the location adjustment, value after location adjustment now is coming out to 10,000, 1.05 million, so plus 70,000, making it 1.12. And the same logic now, if I carry on, the location advantage or location adjustment is coming out to that particular scenario. Then for the last 2 years, the sales prices are appreciating at 0.5% per month. Now, when was it sold? Selling date. This was sold 12 months back. This was sold 14 months back, and this was sold 6 months back. So I have to adjust for if it had been sold today, because the D is what I am planning to sell today. So if this has been sold today, I can sell at 6% more. So date adjustment, I am able to sell it at generally a 6% more. So probably again this I am increasing by 6%, whereas this I am increasing by 7%, and this I am increasing by 3%. So after date adjustment, the price is coming out to be something like this. This is what is the price after the date adjustment, and now all the adjustments are typically taken care of. So after that, whatever has come out, that is what is the adjusted sales price. And what I can find out is, so adjusted price per SFT, which I can simply compute this as this number divided by the size. So this is almost 39.33 per SFT, 76 and 15. So these are actually not better comparable properties, but just for computation, average adjusted price per SFT, I take the average of all the comparable properties, and whatever this is the average adjusted price per SFT. So which means the estimated selling price for D. So I can very well compute it as this is the price per SFT multiplied by 25,000 SFT for this. So I can say that this property needs to be sold at 1.095 million using the sales comparison kind of an approach. So this is how we identify the various comparable properties, and based on this particular numbers we try to arrive at finding the value of the property of our interest. So adjust all the characteristics of the comparable property to the property for which we are doing the valuation. Based on that, arrive at what would have been their prices if at all the features are similar to our own property, and based on that adjust their prices and use those adjusted prices to find out the price per SFT, and from there use that average price per SFT multiplied by number of square foot for the property of our choice, and then take it to compute the estimated selling price for that particular property. Alright. Then when it comes to the real estate investments, there is a huge amount that is going into the investment process. So most of the times what we see is even the due diligence is very high. and the costs associated with due diligence is also very high. But still people go ahead doing enough due diligence because there is a huge cash outflow that is involved, and it can result in so many legal problems and physical problems and damage issues, the cost of quality not being the quality of the structure not being appropriate. Lot of things can come and create a lot of headache to the investor. So from that standpoint, the common due diligence mechanisms, again every due diligence is a cost, but people get into a very deeper survey of the properties, do a lot of regular inspection of the property before they actually make their decision to purchase a property. They verify the legal documents thoroughly, identify any kind of hypothecations or any such kind of legal assignments that have been done on that particular property. What was the lease history for that particular property, or what is the rental history, what is the occupancy rate, right? What is the kind of from all the dimensions, typically a very in-depth due diligence happens before any kind of investment happens on that on the property, and any compliance with respect to the regulations or the construction norms, all these things, whether they are adhered to or not, everything is being checked before doing anything in terms of investment in the real estate properties. So, and there are a few indices, just like we have stock indexes, bond indexes and all. For a private real estate also we have different kinds of indices. So majorly they are classified into appraisal based index and transaction based index. So the appraisal base is always looked based on the returns. Appraisal is nothing but growth. So it is primarily looked at in terms of returns. An index is purely based on the returns. So a set of properties for which each of them the return is computed as net operating income minus whatever the capital expenditure that has gone into it plus change in the value. Just like in case of equities we do D1 plus P1 minus P0 by P0. This is exactly the same mechanism that we are using to compute the return, and all these returns we are doing a value weighted based on the returns. So the value of that, okay, if the property 1 is having a value of x1 and property 2 is having a value of x2, and this has grown by 5% and this has grown by 10%. Now all we are saying is the whole index, let's say initial index was 100, right? So the value weighted is based on the returns of the separate properties. So the typical an x1 weight property has grown by 5%, whereas the x2 weight one has grown by 10%. So the return which I will be taking is x1 times 5% into x2 times 10% divided by x1 plus x2. So this is what is the value weighted return based on the returns of the separate properties. Whatever is the value that I am getting, that I am calling as the index based on the appraisal base. But for this is purely based either on the market value, and what could typically happen is, even if the market changes quite drastically, economic conditions change quite drastically, the appraisal happens only at predefined frequencies, probably every quarter. So because the appraisal happens at predefined frequencies, whereas the economic conditions can change suddenly also, what we generally say is the appraisal values, they adjust very slowly even though the market conditions shift very drastically. So that's the reason we say generally appraisals generally lag the transaction base, because by the time the appraisal happens, the transaction itself should have got over, because only based on the transactions that are getting done we can find out the change in the market value of the property. So the transactions are already occurring by the time the appraisals are typically taking place. Because of their slowness in the moment, the appraisals taking time to get incorporated, they are typically treated as having less volatility and low correlation with the other asset classes. So the appraisal based indices, they lag the transaction based indices, but at the same time they have the low volatility and low correlation with respect to other asset classes. But on the other side, we have a few real estate indices which are purely transaction based. So here, based on the individual properties that are getting sold, so each and every property that is getting sold is taken into this hedonic price index and their prices, a kind of a regression model, prices as the dependent variable and the various individual features or the characteristics as the independent variables. We are trying to find out the prices, and depending on how the price is changing, the index value is getting updated accordingly. So this is a mechanism which explains the change in the prices with respect to the individual properties and the differences in the characteristics of the individual properties. And at the same time, we have something called repeat sales index, which is purely based on repeated sale of the properties. So wherever any property is resold, what is the change in the condition, and because of the change in the condition, this property is getting sold at a higher price or a lower price, and based on that the index value is also updated. So generally this is applicable only to those properties where we are talking of a resale. So generally for residential properties which are held for longer holding periods, this kind of index may not be an appropriate index for the comparison purposes. So looking at comparing your particular real estate return with respect to the industry, we should look at these kind of mechanisms and do the appropriate comparisons of the performance. So as we look at the various factors that are affecting the value of the property, the operating expenses, the higher they are, the value of the property will come down. And as we have discussed earlier, the operating expenses should not contain the interest expense. Even the taxes should not be, property tax should be included, but not the income tax. So after adjustment for all these things, we just need to look at what are the operating expenses, the integrity of the structure, how good is the design, how good is it a reflection to the current days without any functional obsolescence and all. So those are the ones that are affecting the value of the property. Environmental issues, the location, where it is located, any kind of in a pollution free zone or such kind of environmental issues, the greeneries and such kind of environmental issues will affect the value of the property. The leases, the rental history, what is the typical tenant profile for this kind of a property, how many times it has been assigned, and can it be assigned for any other kind of financial loans and other purposes, the tax histories, all these things, they typically impact the value of the property in a very heavy manner. And as we were discussing earlier also, typically in a real estate you find leverage as one of the most important aspects. Most of the real estate transactions happen through the borrowing process itself, so debt plays a very significant role. So as long as the property returns are more than the interest that you are paying on the loan, there is a benefit by taking the loan. The typically what we call as is the IRR will be much higher itself. So the leveraged IRR is what is a word which we generally used in this case. The returns will be much higher to the equity investor by going with the loan. So as long as the property returns are greater than the cost of debt, it is very much worthwhile going with the loan. But it goes the other way if the property returns are much lesser or they are falling, the risk is also getting increased accordingly. So from an evaluation standpoint, generally the analysts look at these kind of ratios, especially when we talk about real estate. Two major ratios that come into a scenario, which is the debt service coverage ratio, generally looked at as net operating income by interest ratio. What is it like? And loan to value ratio. So what is the property value to how much loan can be given? These are the two things that are typically taken into consideration to decide what should be the maximum amount of loan that can be given to a particular borrower. If we see, okay, a property has a value of 2 million. Lender is willing to give a loan at 12% interest only if the DSCR, debt service coverage ratio, is maintained at 1.2. Means NOI by interest is equal to 1.2. That's one. And loan to value ratio not more than 75%. So at least going with the loan to value ratio, so I can say the maximum loan can be 1.5 lakhs, 1.5 million, because the value of the property is 2 million and loan to value ratio cannot be more than 75. So as per the loan to value ratio mechanism, the maximum loan that I can be given is 1.5 million. But I want to check it even with this. Assume the NOI of the property is 200,000. So based on this, NOI by I should be 1.2 because the DSCR is expected to be 1.2. So from here I can find out the I as 200,000 by 1.2. So what should that be working out to? So I is 200,000 by 1.2. So the I, so the yearly interest is expected to be 166,667, and the interest is 12% of the loan. So loan value into 12% should be equal to 166,667. So the loan value should be 106 interest amount divided by the interest percentage. So this is coming out to 138,000. So sorry, 1.38 or 1.39 million. So as per the debt service coverage ratio approach, I can be given only 3.19 million. So overall, the maximum loan that I can get in this process is only 1.39 million, which is the maximum out of these two. So this is how the debt service coverage ratio as well as loan to value ratio are used to decide what should be the maximum amount of loan that I can get. So in this case, it is saying I can get a maximum loan of 1.39 million. So in this case, now I can look at that being the debt. So let me look at it now. The debt is 1.39 million and the equity in this case is 2 million minus this. Okay, so this is the debt, this is the equity. Fair enough. Now to evaluate the performance, we are looking at the various ratios. So let's say I want to find out the equity dividend rate. So as an equity, I am investing this much, and how much I am getting every year, because the NOI is 200,000. Out of that, if my debt is 138, okay, if my debt is 138, the interest that I have to pay out of this is 166. So out of the 200,000 which is getting generated as NOI, out of the 200,000 that is getting generated as NOI, 166 is going for debt servicing. So typically 33,000 is what is left for the equity investor, So equity dividend rate. Equity dividend rate is nothing but what the equity investor is getting after the loan servicing divided by what is the equity capital that has been put up. So which is working out to only 5.45%. So in this case the equity dividend rate is very pathetic. So unless the NOI of the property goes up, the equity investor is not getting much of a benefit in it. So 5.45% is the equity dividend that is coming out in this particular transaction. Then we are also talking about the IRR, assuming that if the property is sold at 2.4 million at the end of 5 years from now, right? Every year, if I assume that the NOI is going to be 200,000, so 33,000 is what the investor is going to get. 33,000 is what is the investor is going to get every period. Equity investor is going to get every period. So obviously when I am looking at leveraged IRR, which is nothing but the initial investment that is being made is this much, right? Initial investment that is being made is this much, out of which this is the amount that is coming each of the periods for the next 5 years. So basically I can very well say I have to find out the rate. So I'll take the rate wherein number of periods is 5. Then the PMT, every year I am going to receive this much, and today I have invested this much as the equity investor, and towards the end I am able to sell it at 2.4 million, and when I am selling it at 2.4 million, I have to repay back the debt, right? I have to repay back the debt. So 2.4 million minus this is the debt, so I am left with that much at the end of 5 years. So based on this is telling that the leveraged IRR in this case for me, by taking the loan, the return which the equity investor is getting by investing 6.1 million on his own, getting 33,000 every year for 5 years, and at the end of the 5th year getting to selling the property at 2.4 million by and returning 1.39 million, his IRR in this entire process is going to be 15.14%. So that is the kind of return he can get in case he has taken the loan. But if I have to say unleveraged IRR, means had he not gone for the loan, he would have invested the entire 2 million on his own. So we'll try to find out the IRR here. No, not IRR, we'll take the rate. So for 5 years he is holding the investment. Every year he will get the entire 200,000 because there is no debt, no servicing relating to it. So he will get the entire 200,000. But today he is investing 2 million, the entire thing. Had he not gone for a loan, he is investing entire 2 million and he is getting 2.4 million fully. So in this case what is coming out, the IRR is only 13%. In case he had not taken the loan, the IRR is only 13.08%, and because of he taking the loan, the IRR for his investment has become 15.14%. So as long as the property growth is more than the cost of debt, taking a loan is more desirable for the real estate investment, which can be computed using the leveraged IRR as well as the unleveraged IRR kind of approaches. So as long as the leveraged IRR turns out to be more than the unleveraged one, it is very much comfortable going ahead taking a loan for purchasing the real estate property. So these are some of the core ratios and calculations that we do to evaluate the performance of our real estate investments. So this is what brings to the end of this particular session, where we have looked at various private real estate investments. What are the various approaches that are available to value those investments, and finally, how do you measure the performance of those investments, and even what kind of ratios we typically look at. Right. In case you have any further issues in relation to this, you can very well get back to me by giving me a call on the number that I have given below, or even you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.